Welcome to another episode of Map Your Money. I'm one of your co-hosts, Arish and Jeff, wealth advisor, certified financial planner, here joined by Jeff Cohn, as always, CFA charter holder, chief investment officer. How's it going, Jeff?
It's going great. Nice to be here in person.
I know.
Wow, what change.
We were crossing paths. We just had to make it happen in person. So we're in the studio today.
Yeah, that's right. Yeah, that's sweet. Yeah. Coming at you from NOLA.
Oh yeah. So we're recording a little earlier. We usually upload every month. We're recording at the beginning of the month now, just since we were crossing paths. But it's August 9th here. I think timing is really important, and just had a week of a lot of volatility. And so maybe by the time this comes out, we've forgotten about all this volatility already.
Fingers crossed.
And I think that's important to recognize too. But going to talk about what we've seen recently, as well as where we're going, and what this means for investors. But like always, before hit a little icebreaker. I'm really excited about this icebreaker. Okay. I mentioned that to you.
Smack me with it.
So what is your Mount Rushmore? Your top 4 forms of potato, like types of potato consumption wise that you like?
Number 1 has to be the baked potato with extra daisy sour cream and butter, along with a spice called Cavender's, which they make in my hometown of Harrison, Arkansas. I cannot leave home without. So that's number 1. Second, obviously, would be mashed potatoes, obviously with Cavender's and hopefully sour cream. Daisy sour cream mixed in. And then, got to round it out with the tater tots and crispy French fries with they got to have that good potato substance underneath.
So baked, mashed, tots, and then
fries.
Yeah, I like it. I'm surprised vodka didn't make the list.
Yeah, well, that's a great form of potato. I do like that form of potato. A little olive juice and blue cheese stuffed olive sometimes.
Yeah. What are other big? This is hash browns are good. I think I'd probably do hash browns over tots. Other than that, mash definitely.
Yeah.
Yeah, it's a good one. There's too many good potato forms out there.
I tell you what, man, it's a versatile food group.
Versatile for sure. Well, we'll get right into it. We can run the intro.
Hello, and welcome to Map Your Money, a finance-focused podcast. We exist to simplify the lives of our clients and listeners and help individuals create the roadmap for their financial future. Content is for educational purposes only. Consult a financial advisor or conduct your own due diligence of investing. Calls are pre-screened and the content was pre-recorded.
All right, like I mentioned, awesome episode talking about a lot of the volatility we've seen. So what's been going on in markets? What's been happening, Jeff?
Yeah, let's set the stage here. So basically since the beginning of 2023 and into 2024, the market has had really great returns, right? I think the S&P 1-year number is up about 20%. And a lot of those returns have been concentrated in a few mega cap tech stocks, like $1 trillion plus 2, even sometimes $3 trillion market caps like Nvidia, Microsoft, Apple, which collectively make up now over 20% of the total S&P.
Yeah.
Right. So those have been driving a lot of the returns of market. And a lot of that has been related to this hype around AI, artificial intelligence, and the investment that is going into that. Of course, that's flowing. Those revenue dollars are flowing to NVIDIA, and they're coming from places like Meta and Amazon, which have a lot of deep pockets. So it's kind of understood that those revenues can continue. But there's been some questions lately about, how profitable are those AI investments really going to be? And some of these, questions have been popping up. And then under the surface, there's this understanding among the finance and kind of markets community that the valuations of these mega cap companies, looking at their price compared to some fundamental like earnings or cash flow, is really widening and outpacing the valuation of basically everything else in the market, right? So there's kind of this question of when, markets go in cycles, and these kind of things typically revert to the mean, right? So the question is, well, when? What's going to be the catalyst for that? And on July 11th, we got a catalyst. We got the June inflation report. It came out, lower than expected. Inflation kind of flared up at the beginning of the year a little bit, and then now it's kind of resumed its downward trend back down to the Fed's 2% target. And so it's understood then that the Fed now has a green light to start cutting rates. And on that day, we saw a huge rotation out of tech, out of those mega cap stocks, and into basically everything else, like mid and small caps, to the point where I think even, you made a comment once, and it's like, well, the market's down today. It's like, well, the S&P's down today, but the average stock was actually up quite a bit, and the dispersion was really wide. And so that really started a lot of volatility on the tech side. And then we got a jobs report last Friday and some other economic data last week that showed that, hey, looks like the economy may be slowing here. And so it kind of reignited some of those fears of recession. And so then we saw a lot of that selling really ramp up across the market. And that's created a lot of volatility. There's been some other things at play, like some short-term technical factors, like the carry trade has really been thrown out there. But a lot of it really is this kind of renewed anxiety about economic health.
Yeah.
And that's what's creating a lot of this volatility. So there's been a lot happening under the surface for quite a while, and we're actually seeing some of those trends kind of reverse after some of this economic data.
Yeah, I think it's funny how you mentioned that period where we had the inflation rating, which was lower than expected. And everyone was like, oh, stock market's down. And it's such an important caveat because I think so many people maybe have that widget on their phone to check stocks or whatever it is on the Wall Street Journal. They see the S&P 500, whatever it might be. I think the S&P 500 or the Dow Jones often is in a lot of people's head is that's the stock market. It's an index. It's covering the whole stock market. If we're looking at the S&P 500, that's just 500 names, which 20% of, like you mentioned, is that those magnificent seven particular tech heavy names.
Well, 20% is just three of those.
Oh, three. Oh,
it's Apple, Microsoft, and Nvidia are all 6%.
Wow.
Each.
Okay. And then I think it's like the top 10's above like 35% now, right?
Yeah.
It's way up
I mean,
there,
it may have changed over the last few days with the volatility.
Sure.
It's close to, I mean, it's at all-time highs. Passing, previously the peak was in early 2000s.
Yeah.
So that's kind of like a harbinger for a lot of people, like, because we know what happened after that.
Definitely. And I think that's such an important metric is people say, oh, the stock market's down or this did this to the stock market. But the stock market's so much more than that. And that's something that we know and make sure that clients have exposure to more than just large cap stocks, which are the Dow Jones and the S&P 500, these large cap. There's small cap, mid cap, international, all of these which make up the entire market. And so it's more of a bigger picture than just that. But I know you also mentioned kind of some economic weakness, but you mentioned a good inflation report. But then I know recently we've seen something that's teetering on the edge that's kind of showing, okay, maybe the economy's not as healthy as we initially thought. Or we've been, even coming into this year, it's always been like, okay, we had this high inflation, the Federal Reserve came in, pumped interest rates up, and it was just, everyone always thought it was a matter of when are we seeing this recession? When are we seeing this economic pullback? Not if. And it just kind of got pushed back and pushed back and pushed back. Now are we starting to see some more economic weakness?
Yeah, I mean, basically, and that's a great way to characterize it, right? Because we've been essentially late cycle, right? In the economy, or some people use a baseball analogy. Are we in the 8th and 9th inning of this economic expansion? And what's happened is we've gone into overtime. And right now we're at like our 15th, 16th inning, right? We're past where the game usually would stop. And it's actually puzzled a lot of economists, and, including us. We talked about expecting a recession and it never really happened, right? And so that understanding that we're late cycle, and so a recession must be coming is creating a lot of that anxiety. And so if you look at some of the recent data we got, part of it was the manufacturing surveys that came in below 50. So 50 is kind of the neutral. So if it's below 50, that means it's contracting.
Yeah.
That looked bad on an overall composite level. But if you look at the components underneath, such as like new orders and employment, it also did not look very good. Like those looked worse, right? And then we got the jobs report that showed that the economy only added, I think it was 114,000 jobs versus expectations of 175,000. But the unemployment rate increased from 4.1 to 4.3%. And so that has a lot of people concerned, right? And so, but I think what's interesting is, the headlines are one thing. We always like to pull up the report, look under the surface and see what's going on with the data. And, I think what's interesting is, number one on the establishment survey that shows how many jobs we added per month, that 114, we're still adding jobs, right? I think like that's really important to know, like the absolute level is coming down, but it's still, pretty positive, right? I think there's a lot of volatility in those numbers month to month. And then on the household survey that shows the unemployment rate, we saw a pretty big uptick in the number of unemployed people, but they separate that out and kind of tell us where that comes from. And so we have, I think it was an increase of like, let's call it 314,000 unemployed people, but 274,000 people were unemployed because they completed temporary jobs, right? So that was kind of like coming down the pike anyway, right? And so like those people, is that really a sign of economic weakness that these people had a temporary job, they completed it, and now they don't have work? There's another component to it too, where, you're counted as unemployed if you're looking for a job and don't have a job. So there's two ways to kind of be counted that way. You either have a job and lose it, now you're unemployed, or you're now looking for a job for the first time. Those people are called new entrants. And what's interesting is we've seen the number of new entrants into the economy increase over the past several months, and the percentage of the unemployed that is because of new entrants has gone from 4% in the depths of the pandemic up to 10% where it was pre-COVID. And obviously, we're seeing that trend in quite a few economic numbers where they're returning back to this kind of pre-COVID level. And the economy pre-COVID was, again, this kind of expansion that it was the longest expansion in U.S. history. It just kind of kept going, kind of this 14th, 15th inning overtime kind of situation. And so I think when you think about those things, it's like, okay, we're not seeing a huge amount of layoffs. We're still seeing demand for workers. We're still seeing wages grow faster than inflation. And so it seems like there's still that appetite and demand for labor. It's just there's not as much appetite and demand for new labor. And so as new entrants are coming in to the labor market, they're finding it's hard to find jobs. Now that is weak, right? And that's that is weaker, but it is normalization to a level where it's like, okay, well, we expect, the actual level to kind of normalize here.
Sure. And you mentioned higher, like more new entrants. Where is that sort of coming from? Is that just like more kids are graduating college, or more people weren't working and now they're looking for work?
Yeah, I mean, think about it as like a proxy for population growth, right?
Yeah.
People typically enter the labor force at 16 to 18. 24 to 59 is considered the prime age working population, right? And for those people, for that group, the participation rate in the labor force is actually at new all-time highs. Right? And the participation rate we have is actually because of a lot of older folks that retired during COVID and never returned. So we have that effect. We have the COVID effect with some people reentering the labor force. But the biggest one really is immigration. Immigration really it's a big political topic, and there's a lot of valid points being made from all sides, right? But it's understood that is positive for the economy. It adds workers into an economy that previously we had a shortage of workers. People that come in that are immigrating usually are looking for work. So they're adding to the labor force. They're usually earning income. So they're putting that back into the economy. They're looking for shelter. They're looking for utilities and food. So it actually is stimulative. And they're just not finding jobs as quickly as they were before. But, 114,000 jobs per month. And that was one of the weakest reports we've gotten in a long time. People are still being put to work.
Yeah, definitely. So I guess where do we really go from here? So we're starting to see some weak economic data. And I know we'd been in this constant period of, okay, good economic data was kind of hurting the market, because then it was this weird dynamic of, okay, they're going to keep interest rates low or higher for longer.
Yeah, the Fed.
Yeah, the Fed. And so now that we're seeing some more weakness, is it looking like rates are going to come down sooner or more aggressively?
Yeah, I mean, like it's been widely expected that the Fed would start cutting rates in September. And that is basically baked, like it's going to happen. Take it to the bank at this point. And Chair Powell last Wednesday said just as much when he's saying, we're focused now on both sides of the dual mandate. Read that as code for, we're no longer worried about inflation. We're worried about the economy and inflation, right? So they obviously don't want inflation to flare back up, but really what's getting their attention is, think about it. They've been pumping the brakes on the economy, and now we're really starting to slow. So what do they need to do? Remove the brakes, right? And so that's going to start happening in September, whether it's 50 or 25 basis points. We're not quite sure yet. And that's creating this rotation, right, from some of those mega cap names into some of those, small caps, mid caps, some other like parts of the value market that, coincidentally, we've been noticing how expensive tech stocks have gotten. And so we've been recommending to, reduce exposure to those areas and actually allocate that across the portfolio, including to some of those other areas of the market, to bonds, to international companies that are trading about, I think it's a 3 standard deviation discount to US. So really cheap. And, that's what we've been recommending. So you see this volatility lately, and you see, the NASDAQ draws down 13, 14%. The S&P draws down 10% over the last month, but mid and small caps are down 1%, down 2%. Bonds are up 3%, right? And so that's actually really helped our portfolios weather the storm, and I think also speaks to why it's so important to be diversified.
Certainly. And so I know we don't know how many more cuts we're going to see after September, and they'll give some guidance, but nonetheless, we're at a higher interest rate environment than is typically normal, and that they want to keep, and they know we need to bring that down. And so I think it's important to kind of recognize what that means for everyday people, what that means for companies. There's so many different things that interest rates affect, as I'm sure you've seen in your everyday life when you think of, okay, I have clients across the spectrum. So I have clients who are looking to buy a house, and I have clients who are deep in retirement and have a large percentage of their portfolio in bonds earning a yield. And so for the saver, higher interest rates is good. You're able to park cash and on a money market earn over 5%. When rates come down, that rate that you're getting on a money market is also going to come down. And I think that's important to recognize, that high yield savings account that you got and love so much, that rate's going to come down as well.
Yeah.
It might not be overnight, but it will happen over a period of time.
It basically will be overnight.
It will be. Okay.
So I think what's interesting is a lot of people don't realize this. The Fed has something called the overnight reverse repo, which is basically where money market funds can park their cash at the Fed and earn the Fed interest rate that they pay for banks on their excess reserves, right? And so essentially a lot of those money market balances are literally at the Fed earning interest that is tied to the Fed funds rate. So when they change it, it literally will go down.
Wow. Okay.
And you'll see like Capital One, Ally, Goldman Sachs, a lot of these, like consumer savings accounts will follow suit.
Definitely. And so another point of that is, okay, so you have money that's on the sidelines in a money market account. Sure, that rate might go down. Does it make sense to stay in a money market? You also have bonds, fixed income, which is another piece of the puzzle where you can lock in a rate for a longer period of time. Of course, now the market's pricing in rate cuts, and that's part of the puzzle as well. But when you purchase a bond and rates go down, the value of your bond, there's that inverse relationship, inverse correlation. So when the rates come down, your value of your bond actually goes up, which is a benefit you don't really get in a savings account or in a money market, which is unique. And so
think of like a savings account as buying a one-day bond every day.
Yeah, that's a great way of putting it. And so a lot of different components that go into it and matter for investors, as well as I know a lot of people's jobs, whether they're in real estate, whether they're at a company that's trying to grow, and with 5% interest rates on bonds, maybe can't undergo a project that they would have been spearheading, versus at 3%, maybe they can take on this new AI project or whatever it might be.
Yeah, I mean, if you're a mortgage broker that relied on a lot of home mortgage refinances to earn your commission checks, the share of refinances has gone down to, like, I think the last time I checked, it was like 18%. Because how are you convincing people to refinance out of their 4 or 5% mortgage when rates are at 6-7%?
Exactly.
Right. So like, and I think you bring up a good point about, savers versus borrowers and investments. We always say we're not trying to determine good and bad. We're really trying to determine winners and losers.
Yeah.
And understanding like where we fit in and how these things are going to affect it. And I think you position yourself that way, you put yourself in a position for success.
For sure. The only other thing I was going to mention, and this might be long gone out of people's sight or mind frame by the time they listen to this and we produce this, but you mentioned earlier on the podcast the currency carry trade, and I know that's been something maybe people have heard slightly or heard Japan for a second and just kind of confused on how that works into what's happening in the market or what that means.
Yeah, so, the Japan stock market dropped 12% last Monday, which was the largest, it was this Monday, August 5th, largest decline since Black Monday in 1987.
Wow.
So carry trade essentially is like, this is like where the analogy picking up pennies in front of a steamroller comes from, actually.
Okay.
So like, and this is how like a company or fund called long-term capital management, busted in early 2000s.
Yeah.
It was like a bunch of Nobel laureates and stuff. So what happens is you pick a currency that has, from a country with like a low interest rate. So this is Japan.
Okay.
Bank of Japan, it's an export economy, very slow domestic growth. So they keep interest rates extremely low. Mm-hmm. And so if you borrow yen at 10 basis points.
0.1%.
And then buy US dollars and invest that at 5%. You're now earning 4.9% on however much money you can assign to that. And a lot of these traders have a huge ability to lever up their bets using futures contracts up to 5-10 times. And so what happens is you get really overcrowded in that trade. The yen depreciates, which is better if you're buying back the yen, right? Yep. And the US dollar has been appreciating, so that's also been good, right? And that's kind of how it works. It has to be a teeter-totter there for the currency pairs. Well, that reversed because the Bank of Japan increased interest rates. And so what happened was the yen appreciated quite a bit.
Yeah.
Interest rates went up. The dollar depreciated against the yen. And so all those investors that were caught in that trade, it really moved against them. And when you have leverage on a trade and it moves against you, that's like a huge loss. And what these traders do is they usually have to sell out their books at the end of the day. And so there's a lot of hedging going on behind the scenes to try to get rid of that exposure. And all these financial markets are connected. So you have, one market that has a lot of flows and the prices are changing. Well, that has to seep its way into the other markets as well, such as the equity markets. So you see this big sell-off. You see sell-offs overseas. Typically, that kind of bleeds its way over to domestic markets, and we saw the 3% decline on one day.
I mean, that sounds like an awesome investment. I can just take out money from Japan and maybe have $1,000 there. But why do that? I can take out. I can lever up. Let me take out 10. Let me take out 100,000 at this 0.1% rate. I just put it in a money market. It's the safest instrument. Make 5% on that. It's 4.9% difference, which is all liability good and well until that reverses or Japan increases interest rates.
I mean, you have to pay it back in yen, and yen are getting more expensive.
Exactly.
So that just really moves against you. So but those kind of things they're short term. They're very technical, and they're typically not something that's like driving markets long term, right? They're like those are the things that we try to tell our clients. Don't really like think about that too much, right? Like these are things that kind of just like dissipate, you know, and volatility tends to cluster together, and we know that, and there's been a lot of empirical studies on that, but eventually it fades away, and these kind of stocks are following earnings and the economy and like those trajectory, and we're in the midst of earnings season right now. Do you know what the EPS year-over-year growth rate is?
I don't. That's earnings per share.
It's about 11% for the S&P 500.
Okay.
Right? And for an economy where we had GDP just come out at, you think it was a recessionary GDP, friend?
Yeah.
No, it was at 2.5%.
Yeah.
Right? I mean, you'd think with everybody freaking out that's what happened. No, we had a GDP report come out a week before this jobs report that showed that we were actually doing okay. So, that helps us give confidence. It's like, all right, we see, market hasn't been volatile for a while, hasn't had a large drawdown. You're kind of like due for one.
Sure.
And then there it happens. And there's always an excuse for it, but you want to think about, okay, what's going to drive this going forward? And I think that's why we've seen such a rapid rebound in cookie.
Yeah.
A pretty nice 2% jump yesterday.
Definitely. And that kind of sparks something that I hear with clients a lot. And they see clients, prospects, friends, whoever it might be, they always say, okay, like stock market's done so well, it's up this much, it keeps going up and up and up. Like how much longer can it last? And just kind of looking at a price on a chart, when I think it's price of these underlying securities is tied to earnings. And if earnings are also growing at a healthy, steady rate up, we're okay with the price going up as well. That's healthy. That's the correlation. Exactly. Yeah. It becomes more frothy or bubble-like when the price is going up, but the earnings really isn't following.
Yep.
And that not really is the case, is it?
No, I mean, like earnings have actually been really strong. Part of the reason why Mag 7 names that we talked about earlier have done so well is because the earnings have gone up.
Exactly.
Like, NVIDIA is looking at like 400% earnings growth over like the past couple of years, right? And the revenue has exploded. I think where you can put yourself at risk as an investor is you're not really buying into, what will their earnings be in the future. You're buying into, will their earnings be better or worse than is currently expected in the future? And so what happens is you can have a company like NVIDIA where you have a lot of optimism built into their earnings expectations. And then maybe, GPU demand isn't quite as strong, or maybe it's 20% less than expected. Well, that's going to impact their stock price, even if their earnings continue to grow at a strong rate because it was supposed to be better.
I see. Yeah.
Right. And so, that's where kind of this AI skepticism is coming from with like the investment, like how much return are these companies going to make? What's the ROI, return on investment, for all this money that they're sending at NVIDIA for these AI applications? Is that really justified? So those are things you pay attention to. It's how much is it priced relative to next year's earnings? Yeah. And how reasonable are those earnings estimates?
Definitely. Well, this has been an awesome conversation. Just kind of over what we're seeing in the markets. Now we're seeing some more economic pullback or hesitancy that we've kind of been waiting on. It's just been something that has been pushed back, and now we're finally seeing some metrics that show the economy might not be as healthy as initially it was, and I don't necessarily think it's cooling.
Yeah, we like to use the term normalizing, right?
Yeah,
an economy I liken it's like a marathon runner, right? Like a marathon runner can run a marathon at pace, at that pace the whole marathon. But if he's running faster than that pace, then he's probably going to have to slow down at some point, right? To where it averages out. And our economy's been running at a fast pace, well above what the long-term trend would be, which is closer to probably 2 to 3%. Well, coincidentally, that's about where we're at.
There you go. Tied it back into the Olympics and everything. I love it.
Boom.
I love it. Well, I'm going to go try to eat some more forms of potato.
The hash browns, you're right, man. I'm actually, I'm wondering if I made a bad choice there, but I don't know what I'd sub it out for.
I'm not a big baked potato guy.
Really?
I take mashed.
You're not using enough Daisy sour cream.
Maybe not.
That might be the case. You need 2 dollops of Daisy.
We also don't have potato chips. I'm going to put potato chips.
Potato chips.
Yeah, I'll count.
Oh, man.
It's too many.
Why did you bring such a tough
It's too many. I know. It's tough. It's tough. Well, appreciate you, Jeff. I'm sure we'll be catching up here soon. But
yeah, I think one more thing I want to mention.
Yeah.
There's a lot of companies out there that are not the Mag 7, that are not tech companies that we think, really offer pretty good long-term opportunities.
Yeah.
There's a lot of different areas, energy, utilities, there's clean energy transition. We just passed a couple of years ago, $1.2 trillion infrastructure package that is still being deployed.
Okay.
And so there's a lot of, we own a lot of companies that are in like asphalt, cement, bulk type of materials like that. That's gonna play in there. And then there's a lot of other types of tech companies that you can buy if you believe the tech ecosystem is going to continue to expand. I think cybersecurity is a very interesting area. Obviously, CrowdStrike is one of the bigger companies there, and they had a pretty nasty boo-boo, and I think they're down about 40% since then. But there's a lot of other companies in that space. There's other tech companies that allow kind of oversight of the total tech platform for large enterprises, right? So I think there's a lot of other different ways that you can play the expansion of the digital economy, expansion of AI, all the energy use that's going to be needed.
Exactly.
That where you don't have to buy the high-flying valuation companies that are already up to 300%.
Exactly. I think people hear AI and they say, okay, I need to own Apple, Google, NVIDIA, Meta, and that's the only way to get exposure to that.
Right.
But there's going to be so many tailwinds and so many other aspects that you might not even think of that are going to use some form of AI or have an impact or a tailwind that completely changes their future earnings, which ultimately changes their price.
Yeah, I mean, think about not just the customers for AI. CEO of JP Morgan Chase was on CNBC a couple days ago, Jamie Dimon, and he was listing the ways that they're already using AI in their banks. He's like customer service, preventing errors, risk management, anti-money laundering systems, right? And it's like, so how much are we missing the picture of how companies completely separate from AI are going to be able to find efficiencies and margin improvement in their businesses by applying it? AI? That's another opportunity, right? And you don't need to own NVIDIA to be exposed to.
Exactly. And right before we set up this pod, I asked ChatGPT, which form do I need to set it up for an in-person interview? Because I haven't done that. So,
wow. And you use 10 times the electricity as a Google search. Unbelievable.
But it was cool. So
that's why we're producing a lot of energy.
There you go. Well, appreciate you for listening. We produce monthly, and tune in next episode.
All information provided by this presentation is for educational purposes only and does not constitute investment, legal, or tax advice. It is not an offer to buy or sell any security or any insurance product. This is not an endorsement of any third party or such third party's views. The information contained herein has been obtained from sources we believe to be reliable and is not guaranteed as to its accuracy or completeness. Whenever there are references to third-party content, this information is intended to provide additional perspective and should not be construed as an endorsement of any services, products, guidance, individuals, or points of view outside of Beam Wealth Advisors, DBA Benedetti Gooser and Associates. All examples are hypothetical and for illustrative purposes only. Beam Wealth Advisors, DBA Benedetti Gooser and Associates does not offer tax or legal advice. Interested parties are strongly encouraged to seek advice from qualified tax and/or legal experts regarding the best options for your particular circumstances.